Now, this is the heart of President Biden's proposals. Some of these come from the Biden administration. Some of these are driven by Senate Finance. Basically, what the president has promised is that tax increases on over $400,000 of income. So if you earn more than $400,000, the first one is really ugly. That is an expansion of the 12.4% Social Security tax. So you personally file a form to report if you're a Schedule C filer, you would file and report your Schedule C income, and that would be used to compute your Social Security tax. Imagine now, after you earn $400,000, there's another supplemental form where you have to report the income above $400,000. We'll talk about that. So if you made $525,000 last year, you would have another $125,000 to report, give or take 12% tax. Call it $14,000, $15,000 of additional tax. So that's going to get real ugly real fast. Restore the 39.6% marginal rate, seemingly like only a small change, but look at the breadth of that bracket. You're going to bring that bracket right now starts over $600,000. That's going to come down to about $400,000. So that's going to be a big change. Itemized deductions today. Arguably, a client says to you, I want to give $100,000 to Children's Hospital of cash. What will that save me? And you'll go, well, give or take $37,000 of savings. That puts $63,000 as your real cost of the charitable gift. That's going to change to where that benefit would only be 28 cents. Something very similar will likely happen with pension plans. Instead of receiving a deduction, you would receive a credit. So these things are going to happen one way or the other. There'll be changes, and you'll have a very busy October, November, and December trying to get clients straight with their 2021 tax planning. Restore the 3% P's limitation. That's a pretty easy thing. We're not going to spend a lot of time on P's, you know that. And there'll be changes to the 199 Cap A deduction. In all likelihood, once you earn over $400,000, that will phase out. I, of course, represent people that have very large incomes, and they're sheltering 20% of it using 199 Cap A. Now, 39.6%. This is often called the Warren Buffett rule. And basically, they're going to try to tax labor and capital the same. If you make over $1 million, this would be a 39.6% rate. And the step-up in basis would be eliminated, which also it certainly appears there will be, write this down, a gain realization at death. Okay, there'll be a gain realization tax at death. This is very similar to the Canadian system. I'm working with a Canadian lawyer right now on a case, cross-border case, and I basically said, this is what we're doing, and she said to me, that's exactly how our statutes work. So what some very wise person is doing is borrowing from the Canadian system so that we don't have to completely reinvent the wheel. The Canadians have been dealing with this for almost 50 years, so they will have already built the mousetrap, if you will, and will probably highly leverage off that. The other thing that would happen is every 21 years in a trust, there would be another gain realization. Now, finally, Senator Wyden, this is very controversial, it is very complex. Senator Ron Wyden, chairman of Senate Finance, is suggesting a mark-to-market tax. What does that mean? What that means is that if you had over $10 million of assets and $1 million of income consistently for 3 years in a row, and let's say you bought Bank of America at $20 and it's now at $41 for easy example, that $21 a gain you're going to have to pick up on your return. Then your basis would be reset, and the next year if it's at 44, you'll pick up another $3 a gain, et cetera, et cetera. Remember, that's going to be limited to a rare group of people with over $10 million of assets and $1 million of income for 3 years in a row. Now, this $1 million of income, this magical threshold, for your clients that are a little bit wealthier, you're going to have to work very hard to keep them under $1 million. You certainly would want to break that 3-year cycle. You'd want to find a way to reduce income at least in one of those years. The objective going forward will be to smooth out income, and all of us will become very good at techniques like charitable remainder trusts, different charitable giving techniques. We'll be working very hard to learn to smooth out income. Now, other things that happened, a lot of these already happened in the American Rescue Act. Some of them will happen in additional bills going forward. Basically, the child independent tax credit has already been enhanced. ACA credit will be expanded. Expansion of EITC, and that was expanded a little bit in this last bill. Changes in the energy credits, first-time home buyers credit, renters credit, and an expanded retirement savings credit. So watch these bills very carefully. Undoubtedly, there will be benefits for them. Some of these, again, you'll recognize were already included in the American Rescue Act that just passed. Now, here's the Social Security problem we were talking about. If you earn over $400,000, so you have this gap, right? Up from 0 to 142.8, you pay the tax. And then once you hit 142.8 today, game over. You don't have to worry about this anymore, right? That's the essence of what's happening. Here we go. What's going to happen real quick here is that 142.8 to 400, there'll be no tax. But once you hit 400, you're back in the game. And that means if somebody made $1 million, let's say your child's orthodontist makes $1 million, from 400 to $1 million, that extra 600,000, she's going to have to pay another 12.4% tax. That's over $74,000. Just do the math real quick in your head. Wow. Can you absolutely believe that? And that's going to be a very painful thing for people that are earning a lot of money.